How's it going, everyone? It's Sam. I want to go through how to reduce the risk of getting liquidated. Now that's a dangerous word in crypto, liquidation. That is the biggest risk when leveraged trading. It basically is how you lose your entire trade. Now, I want to go through how to reduce that risk to make really large profits during the bull run. Now, of course, there is risk in crypto. There's also risk in leverage trading. Leverage trading is riskier than just buying spot cryptos that are large caps, right? Like if you go buy Bitcoin, that's pretty much the lowest risk thing you can do in crypto. This is going further down the risk spectrum, but there also are much higher potential rewards or much higher potential profit for leverage trading. We've been able to make thousands of % on some trades this bull run. So I want to go through how to do this, right? How to reduce the risk of the worst thing that can happen while you're leverage trading. Now, I went through a 40-minute example of leverage trading in the Patreon recently. So far, just a few days ago, we opened up 25 more spots. We have half of them remaining. So if you do want to join the Patreon, there's a link underneath the video. And if you want to join the premium tier, you get access to actually ask us to make full videos, request full videos from us. So yeah, I think it's a great use of money during this bull run to really get your questions answered and potentially make a lot more money just because you have some clarity on the questions that you have. Also, if you want to trade, if you want to leverage trade, there is a link down there to BITUNIX. We're going to be talking about trades on BITUNIX. I really like the platform. They don't have KYC. You don't need a VPN, so you can sign up in just a few minutes without giving out all your personal information. A lot of people in crypto don't really like to give out the personal information. People don't want other people to know how much crypto they have. And it's just much easier to sign up to an account like this. Of course, read the terms and conditions. When you use the link underneath the video as well, you can get up to $5,500 in new rewards and benefits for joining the platform. Now, first of all, I think we should go over what leverage trading is before we get into how to reduce liquidation. So if you don't know what leverage trading is, it's basically allowing you to buy more crypto than you'd be able to buy with just your money. So let's say I have $100. I can go buy $100 worth of Bitcoin, but let's say I join BITUNIX and I go 5x Bitcoin. I open up a long trade at 5x. So you can change it right up here, 5x. You can then go buy $500 worth of Bitcoin instead of $100 worth of Bitcoin. So it allows you to buy more Bitcoin than you would be able to buy otherwise. Then if the price goes up, you make a lot more money. If the price goes down, you can lose more money. So let's just do a super simple example. If I go 2x Bitcoin, right, I reduce it all the way down to 2x. And then I go buy some Bitcoin. Maybe, again, let's say $100 worth of Bitcoin I have as collateral. And I am on 2x Bitcoin. Let's say Bitcoin goes and doubles in price. Instead of getting 100% return, I would then get a 200% return. So let's just break down the math there. If I have $100 and Bitcoin doubles, I would have $200. But if Bitcoin doubles and I'm on 2x, then I'd have $300. So $200 worth of profit. This can be extrapolated out. You can do something like a 10x leverage. And let's say Bitcoin goes and doubles, you get 10x the return. So let's say Bitcoin goes up, I don't know. Let's say it goes from 100,000 to 110,000. I could get a 10% return if I bought spot, or I could get 100% return if I'm on 10x leverage. This is where you can see people start to get very interested, and you can make money from little moves up and down. So even if the market just chops sideways, if you read something in the charts that says we're going to bounce at a certain level, you can make good money. Here we put in a trade. You can see we had a downsloping resistance. We got rejected, flipped above, then bounce off of this as support, which is a pretty normal thing to see in a bullish market. And we put in a long trade right here. We moved up here. Now we're up 21% on Bitcoin. So pretty good return. Now we're on 5x leverage. So if we weren't using leverage, if we just bought spot Bitcoin, we would be up about 4%. So instead, we're up 5 times as much. Now, this isn't risk-free. Let's say we bought at 101,000 and we're on 5x leverage. If we had bought here at the wrong time and we started to go down in price, we could get liquidated. So I actually added more margin to this trade, but let's say you buy at 100,000 and you're on 5x leverage, you get liquidated around $80,000. So again, if you're on 5x leverage and you go down 20%, you lose your money. They close out the position. So you're not going to owe them more if you're on isolated margin than what you put into the trade. So again, if you have $100 in the trade, you can only lose the $100 in isolated margin, but you lose that at a much quicker pace. Does that make sense? I hope it makes sense. Let me know in the comment section if it makes sense. So to the upside, you make a lot more. To the downside, you lose more. Bitcoin doesn't have to go down to zero for you to lose your entire position if it's levered long. So how do you reduce this risk? The biggest risk in crypto leverage trading is getting liquidated. So how do you reduce it? Okay, let's say we open up a trade. So we're on isolated margin, 5x. We open the position. You can change how much you want to buy here. We open long. Boom. This is our trade, right? We opened it at $101,100. We're at $105,000 now. Our liquidation price is about $76,270. So if Bitcoin's price starts moving down, we could get liquidated and lose this $1,000 in margin that we put up. So how do we reduce this risk? Well, one, even before the trade, you can use lower leverage. So what's that mean? Well, instead of going 125x leverage or 100x leverage or 50x leverage, we go lower leverage. That's something that I do. Regularly, I go 3 to 5x leverage. Every once in a while, in very specific scenarios, I'll go higher leverage, but this reduces the risk of liquidation a lot. So again, using the example that we used before, if we're at 100,000 and we have 5x leverage, our liquidation price would be right around $80,000. So we opened up this trade when we were bouncing up. So we were in a bullish pattern, right? We were moving up. We had flipped resistance into support. But if we continued back down, we would have had $20,000 before we got liquidated, which there have not been any times where we fell below this 89,000 within the last couple months. So we have strong support. Strong support just means that we bounced off the same level several times. So we would have strong support between 89,000 and 93,000. We'd already seen a pullback as well. So that's something I look for. I don't want to be going super aggressively long when we're at new all-time highs. No, I like to wait for a little bit of a pullback for us to bounce off support, and then I go long. So that's another thing, right? Give yourself some cushion. Don't go super high leverage at all-time highs. That's probably the number one thing that you can do to reduce your risk of liquidation. A lot of people want to go 50x or 100x because you can get really large returns, but you can also get liquidated a significant amount of the time. Something else you can do, which I did, is add margin. So you open up the trade. We had a 5x leverage position, but we opened at 101,000. So our liquidation price should be around 80,000, but you can see it's not. It's around 76,000. So how is that the case? Well, you can add a little bit of margin. If you're an isolated trade, which you can change right over here, isolated trades, you can click here, hit margin, and you can add a little bit. So let's look here. Our liquidation price is 76,270. Let's say we get further down, we're closer and closer to our liquidation price. We could add, let's say $10, and it would reduce it from 76,270 to 76,016.5. So it would reduce our margin, or it would reduce our liquidation price, making it so that we are less likely to hit it. And that will greatly reduce your risk of liquidation as well. Now, where would you maybe want to use that? Well, let's say we start to fall down and you're still bullish on Bitcoin for the long term, but we're getting closer to your liquidation price. You might say, well, the price of Bitcoin got rejected around 73,500 and 74,000, like several times. We got rejected here. So if we start falling down, we might flip this resistance into support. So we might start moving up. But my liquidation price is around 76,000, which is actually still above where we will bounce off of. So we would come through my liquidation price and then bounce up. You could add some margin. What would it take? Well, let's see. If I added $100 worth of margin on this $1,000 trade, it would take my liquidation price down to 73,726. So realistically, I might want to add a little bit more because sometimes we go right below the prior resistance to try to liquidate different traders, and then we bounce off of it after that. So you might want to put your liquidation price slightly below where you think it's going to bounce. So that's another thing you can do. Again, you can just add margin, make it liquidation price slightly below where you think it's going to bounce off of, and that can greatly reduce your risk of margin. This is something that I did not know at the start of my leverage trading career, and I wish I did because it would be greatly beneficial. It would have been greatly beneficial because you can adjust your trades a bit over time. Another thing that I've done in the past is I've gone a little bit more aggressive with my leverage, but I put a little bit less into it. So instead of going maybe 5x leverage, I might do 10 or 20x, but I might put in half or 1/4 as much. And then if I do get liquidated, then I have money to open up a new position right at the liquidation point. So again, let's say I get liquidated at $90,000 Bitcoin on 10x, right? I buy at 100,000, I get liquidated at 90,000. I have a buy order right above that $90,000 mark. And then if we go to 90,000, I buy, I get liquidated, but then my new liquidation point is 81,000 on 10x leverage because it's 10% of 90,000. So then I might have another limit order at 81,000 or 81,200, something like that. So that I still buy right above the liquidation point, and I just put in less in collateral and make sure that I have money for future dips. This means that less of your money is tied up in trades. So if we move to the upside, you have a little bit more leverage. You're using more a higher leverage, but you have less in collateral that you're using. Another thing you can do is put stop losses on. So we bought at 101,000. Even though our liquidation price was in the 80,000s, I could have reduced the risk of getting liquidated by just putting a stop loss below this trend line. So I could say, well, if it goes under 95,000 or so, I think we're going to go down much further, right? So I could have put a stop loss. You just hit this, TP/SL. And you could put a stop loss down here. So instead of losing 100% at 80,000, you could just close the trade when you're down about 25% on the trade. Another thing you can do when you're in the profit here, you could put a stop loss closer to where you actually got in. So let's say I just wanted to make sure that I get some kind of profit in this trade. I'm up 21% right now. I don't want to close the trade, but also I want to make sure that I gain something. You could put a partial stop loss or a trailing stop loss. So you can say, well, if we get down to 102,000, I just want to make sure that I get some kind of profit out of it. Or maybe, I'm falling asleep and I have a trade and maybe I went more aggressive. Maybe I have a 20x trade and we're up, 100% right now. And maybe something goes wrong in the middle of the night and we crash down. I just want to make sure that I get some profit out of it. Again, you can put that stop loss or you can put take profit too. Let's say you say, well, I think we're going to get rejected around 109,000, which is just short of where we went before. And then I think we're going to come back down and I think we're just going to trade in this range. Well, you can put a take profit right around 109,000 as well. So there are a ton of different things that you can do to kind of adjust risk parameters during your trades and after you've already set up the trades. And I think this all is really beneficial to know as a newbie investor or a newbie trader, because again, you need to learn how to reduce your risk over time, how to reduce the risk of liquidation. Now, if we go into a bear market, that's the worst case scenario for a long investor, right? If you are someone that has a lot of long positions, you can keep on adding margin and adding margin and adding margin. But if we keep on falling down, you can still get liquidated. So there is still some risk. But that's a great thing about leverage trading as well. You can actually make money from it falling down because you can short the market. I don't typically like to do that, but it does provide a hedge for some people that want to bet that the market's going to go down. Let me know your thoughts on all this underneath the video. I think that this can be hugely beneficial, but you have to know what you're doing. I've given this example before, but I think of leverage trading kind of like using dynamite. Like, you can try to clear rock by hand and it takes a long time, but you can get it done. It's safer than using dynamite. Or if you know how to use dynamite, you can clear a bunch of rock really easily, but you can also blow off your hand. So you have to know what you're doing. And if you know what you're doing, you can get what you want much faster. But of course, you have to understand risk. You have to understand how it works. You probably have to start out with a small amount and then try to add more to it over time. And to be clear, I do not think that this is smart to do with the majority of your portfolio, not anywhere close to the majority. You have to start with a small percentage of your portfolio. Let me know your thoughts. Thank you so much for watching. Check out the links underneath the video to BITUNIX and to Patreon, and I'll see you all in the next.